Welcome to FT Markets. The idea of charging investors for holding cash in order to stimulate investment in the wider economy has largely been restricted to academic debate, with few real-life examples. However, that changed last June when the European Central Bank became the first institution of its kind to impose a penalty on banks wanting to park their surplus cash there. Since then, short-term lending rates in the Eurozone have fallen into negative territory, and more recently, the volume of negative-yielding government bonds has swelled to over €1 trillion. With me to discuss this phenomenon is Barnaby Martin, Head of European Credit Strategy at Bank of America Merrill Lynch. Welcome, Barnaby.
Thank you.
How did we get here then?
Well, we got here rather quickly, actually. If you rewind and think about halfway through last year, we lived in a world where there was basically no negative-yielding government debt. And then came along the extraordinary policies of the ECB, where they cut their deposit rates into negative territory, and we suddenly found that large swathes of the government bond market in Europe began to trade through zero. We now live in a world early on in 2015 where we find that there's 1.4 trillion euros of Eurozone government debt which are now yielding below zero. And it's not just confined to German bonds. You see that it's across the government bond market that this problem of negative yields exists. And actually it's now just a global phenomena as well. There are 10 government bond markets which suffer from negative yields. Believe it or not, it's Japan which is top of the list with a huge amount of their government debt trading below zero.
I guess that would make sense with their quantitative easing program. If we go to our first graph, we can see how the short-term money market rates have steadily been dropping with each ECB decision, and indeed in mid last year when they decided to cut the deposit rate, EONIA, the overnight lending rate, has gone into negative territory, followed nearly by the 1 month and 3 month lending rates. Barnaby, why on earth would investors potentially want to buy a negative yielding debt security?
Well, I guess there's two ways to answer that. The first is that investors have been in these securities before and have seen the effect of QE coming and have seen the effect of central banks and have said, look, I want to remain in this asset because it's still going to go up in price. So while it yields negative, it's actually returned a lot for investors previously. I guess the second reason that you'd want to own it going forward is if you are skeptical that the QE policies from the ECB is actually going to end up creating any tangible growth in Europe, any tangible recovery. And ultimately, you may feel as an investor that it's worth paying a few basis points away on your Bund holdings to remain in probably what's going to be one of the safest assets going forward.
And indeed, on the question of Bunds, if we go to our second graph, we can see how costs have fallen precipitously and indeed gone below zero on the 5-year Bund only quite recently. So does this tell us that essentially investors have rather little confidence in the Eurozone's economic prospects?
Well, it tells us a number of things. It tells us how rapidly the inflation numbers have fallen in Europe on the back of the oil price. But it also tells us that we think on Thursday we're about to have one of the largest QE programs announced, and we're going to have a situation where the central bank becomes a very aggressive buyer of government debt in Europe. And in that situation, when the ECB is desperate to buy and there's not a huge amount of stock of bonds available for them to buy, prices go up. So in many ways, the situation of low and negative yields reflects the fact that the ECB are becoming a big asset gatherer in Europe.
And indeed, one effect of negative 5-year Bunds, if we go into our last graph, has been falling peripheral bond prices as well. So investors essentially, to pick up any yield, have to go into countries or indeed companies or banks which have more credit risk in order to get a pickup.
Yeah, but in many ways, that's really the aim of the ECB here. It's to compress peripheral risk premiums. I mean, one of the consequences, I mean, this chart doesn't show it, but actually one of the motivations for the ECB at the moment is to reduce real interest rates in the periphery, which have actually been creeping higher because the inflation numbers have been falling so quickly. So what this chart tells me is that the aim of the ECB is really to keep those premiums coming down and to ease credit conditions in the periphery.
And do you think we could see a negative corporate or even bank bond this year?
Well, we're close. There are a few short-dated corporate bonds that are yielding slightly less than 10 basis points. If over time we hear the ECB unveil a QE program which includes corporate bonds, which isn't the B of A base case, but over time if they did, then they would definitely have the ability to push some corporate bonds into negative yielding territory. If they don't, then again we've got to rest on the theme that there's so much negative yielding money looking for a home in better assets that asset allocation flow into credit can still push spreads tighter.
Thank you, Barnaby.
Thank you.
So the stock of negative yielding debt securities, both in the Eurozone and also globally, is set to grow yet further as investors' confidence in an economic recovery dims worldwide.